Welcome to the deep dive, where we cut through the noise to get you the core insights. Today, we're zooming in on a company that's, well, virtually invisible, yet utterly indispensable. Taiwan Semiconductor Manufacturing Company, TSMC. If you're holding a smartphone, using a laptop, or seeing the explosion of AI, yeah, you're interacting with their work. Now, you've handed us this comprehensive valuation analysis for TSMC, just brimming with numbers and ratings. Our mission today is to decode it for you. We're going to unpack why, despite some truly, eye-watering current financial metrics, TSMC has earned an overall attractive valuation rating. It's a bit of a puzzle, isn't it? And we're here to solve it with you.
It is fascinating, yeah. We're not just analyzing a stock here. We're really peering into the engine room of, well, global tech innovation. This exploration will show us how financial metrics can tell different stories, sometimes even conflicting ones, depending on your perspective, and why understanding the time horizon, you know, from what just happened to what's maybe brewing next year and the year after is just absolutely crucial for a giant like TSMC. From the jump, what grabs me is this tension between what the market sees today and the immense potential that seems to be waiting in the wings.
Okay, so let's pull back the curtain then. Our analysis, it's dated September 3, 2025, and it lands TSMC with an overall weighted valuation rating of 3.53 out of 5 stars. That's labeled attractive, which, that's a bold statement, especially for a company of TSMC's size and market presence. How exactly did we get to that attractive label?
That's a great question, because it's definitely not a single snapshot in time. This attractive rating, it's actually a weighted average. It's split equally across 3 distinct time horizons. Think of it like looking at a journey from, say, 3 different vantage points. First, we have the trailing 12 months, or TTM. That captures recent performance, what's already in the rear-view mirror, so to speak. Then we look forward to the current fiscal year, FY 2025, which we call FWD1. That's like peering just over the dashboard. And finally, maybe the most impactful lens here, the next fiscal year, FY 2026, or FWD2. That's looking further down the road, anticipating what's coming around the bend. Each of those perspectives contributes to 33.3% to that final 3.53 score.
Okay, and what immediately jumped out to me is that those ratings, well, they aren't all sunny from the start, are they? The TTM analysis, our rearview mirror, comes in at 3.24, which is just neutral. And even the FWD1 for the current year, FY 2025, that's a 3.30, still sitting squarely in neutral territory. But then, whoosh, the FWD2 for FY 2026 takes this dramatic leap, soaring up to 4.05, firmly attractive. That's a huge shift. What's driving that sudden burst of optimism looking further out?
You've hit on the absolute core of this deep dive.
Yeah.
That dramatic leap in the FWD2 rating is the story here. The initial neutral ratings for TTM and FWD1, they reflect a really interesting balance, I think. On one hand, some market-based metrics, like, say, price to sales or price to book, they are quite high. They definitely signal that the market already has significant expectations for TSMC's growth baked in right now. But on the other hand, earnings-based multiples, like price to earnings or EV to EBITDA, are much more reasonable, particularly when you stack them up against the, frankly, sky-high valuations of other booming AI players. The attractive rating only really materializes when we look 2 years out. This strongly suggests that the market today, well, it isn't fully pricing in TSMC's anticipated medium-term earnings power. It's almost like there's a hidden discount on its future growth.
Interesting. So if the current picture for a company as dominant as TSMC still looks a bit neutral or maybe even stretched on some fronts, where does that future attractive rating really come from? We need to dig into the specific metrics, right? See the push and pull.
Exactly. Let's break down the current view first, using those TTM numbers. On some fronts, the valuation does appear, well, let's say unattractive. For instance, TSMC's price-to-sales ratio, PS, it's about 8.4x. And its price-to-book ratio, PB, that's roughly 7.5x. Both of those are near the higher end of their historical ranges. What this tells us is that based on its assets and its sales, yeah, a lot of future growth is already kind of baked into the stock price. Investors are clearly betting big on what's to come, demanding a premium today.
Okay, so that's the pricey side based on sales and assets. What about when we look at earnings?
Right, so if we switch to, exactly, it's not just a number in isolation, it's a window into market psychology. While TSMC's PE today looks maybe a bit stretched against its own history, it looks like a relative bargain compared to the, exponential growth narratives priced into some others. This suggests the market acknowledges TSMC's leadership, sure, but perhaps hasn't fully bought into the same level of future growth euphoria as its peers, which, potentially leaves more room for appreciation.
Makes sense. And the EV to EBIT.
Yeah, the EV to EBIT ratio of about 16.3x, that sits pretty comfortably right in the middle of its historical range. Seems quite reasonable for a company with TSMC's market dominance and, frankly, phenomenal operating margins.
And you mentioned some attractive elements even now.
Yes, even in the current TTM data. The EV to EBITDA ratio, that's approximately 11.5x. Now, this is actually below its 5-year average, and it's substantially lower than many high-growth tech companies. This metric, it strips away some accounting complexities, right? It shows a company's raw cash-generating power. And here, it's signaling a genuinely attractive valuation based on operational efficiency.
Okay, so that's looking strong already.
It is. And furthermore, Wall Street seems to agree. Consensus analyst price targets imply about a 15% upside from current levels, and a comprehensive discounted cash flow, or DCF analysis, suggests the stock is roughly 13% undervalued. So these aren't just opinions. These are financial models pointing to potential upside right now.
Okay, so we've got this nuanced current snapshot. Some metrics look pricey, sure, others look quite favorable, especially when you compare them against peers. But as we saw with that huge jump to attractive for FY 2026, the real game changer is undeniably looking ahead. How do these forward-looking numbers paint such a different and, well, much more optimistic picture?
That's where the magic, if you want to call it that, of multiple compression comes into play. It's a key concept here. Imagine you're buying a piece of land today. Based on what's on it right now, the price might seem fair, maybe even a little high. But if you know that in 2 years, a massive value-generating development is absolutely guaranteed to be built there, well, suddenly today's price looks like an incredible deal for what you'll own in the future.
Ah, I see.
That's essentially what multiple compression implies for TSMC's future earnings. The current stock price, divided by those much larger projected future earnings, results in lower, more attractive multiples.
Okay, so let's see the numbers. How does that play out for FY 2026?
Specifically, looking ahead to FY 2026, the PE ratio compresses significantly. It drops to about 21.1x. Now, this becomes undeniably attractive, especially when you consider TSMC's projected, 13% EPS growth, and its utterly indispensable role as a critical technology supplier for, well, the entire planet.
Right.
Even more strikingly, the EV to EBITDA ratio, that drops below 10x. It gets down to about 9.7x. For a company with TSMC's market dominance, consistent profitability, and robust growth outlook, I mean, that's a very attractive level. It's a truly compelling valuation based on its projected cash earnings.
Wow, below 10x EV to EBITDA for TSMC. That is interesting. What about the sales multiples? They looked high before.
They did. But even the PS ratio, which looks stretched for TTM, improves quite a bit. It comes down to around 7.5x for FWD2. Now, while you still wouldn't call it cheap maybe, it becomes neutral and far more reasonable when you consider TSMC's sustained double-digit revenue growth trajectory. Okay. And finally, the EV to revenue ratio, looking at enterprise value against sales, that's about 6.0x for FY 2026. That becomes attractive as it falls well below its 5-year historical average, again signaling a more favorable valuation against those strong projected future sales.
So what this all boils down to for you, the listener, is that the current stock price, according to this detailed analysis, isn't fully giving credit for TSMC's future earnings potential, particularly in that medium term FY 2026. It's kind of a classic case of expected growth catching up to and then potentially exceeding the current valuation multiples. The market, in essence, might be playing catch up to TSMC's anticipated trajectory. But numbers are only one side of the coin, right? What's the story behind these impressive projections? What makes TSMC so fundamentally robust that analysts can confidently forecast such strong future performance? What are the underlying engines really powering this future-looking attractive rating?
That's exactly where we need to connect the dots, yeah? Between the financials and the core business itself. And TSMC's foundation is, well, it's rock solid. First off, their exceptional growth profile. TSMC isn't just riding the AI wave. In many ways, they're generating the waves. Their growth is directly fueled by this just insatiable demand from secular trends like AI and high-performance computing, HPC. They are absolutely at the forefront technologically speaking. Leadership in advanced process nodes like 3 nanometer, 2 nanometer, serving the most critical players. You know the names Apple, NVIDIA, AMD.
The big ones.
The biggest. That's why analysts are forecasting robust EPS growth over 12% annually for the next 3 years. This isn't just speculation, it's tied to fundamental demand drivers.
And the profitability. Second point. Best-in-class profitability. This company consistently delivers incredibly high margins. Gross margins averaging 55% over 5 years, operating margins averaging 46%. These aren't just numbers. They reflect immense pricing power and a technological moat that very few, if any, competitors can replicate. And when you see high returns on equity around 31% and invested capital about 17%, it just underscores their mastery at turning that innovation into substantial profit. It's efficient.
Okay, growth and profits. What about financial health? They spend a lot on new factories, right?
They do spend enormous amounts, which leads to the third point. This formidable business is built on fortress-like financial strength. TSMC maintains an incredibly strong balance sheet. Their liquidity is excellent current ratio consistently above 2.0, and their leverage is remarkably low, a debt-to-equity ratio of just 0.22. Think about that for companies spending billions on CapEx.
Very low.
Extremely low. This financial prudence allows them to fund those colossal capital expenditure programs, building those cutting-edge fabs without breaking a sweat, essentially. It's a deep well of resources. And that spending doesn't hurt cash flow.
Well, that's the fourth point. Powerful cash flow generation. Despite pouring billions, literally billions, into those massive new fabs, TSMC consistently generates strong free cash flow. This means they can self-fund their aggressive technology roadmap, keep pushing the boundaries of chip manufacturing, and still reliably return capital to shareholders through dividends. It's really the hallmark of a self-sustaining, growth-oriented enterprise.
Okay, strong fundamentals all around. And Wall Street agrees.
Seems so. That's the final piece here. The overwhelmingly positive analyst sentiment. Wall Street largely echoes this assessment. TSMC gets a strong buy consensus rating, and the average 12-month price target implies, as we mentioned, a healthy upside of around 15% from current levels. So yeah, even the professional experts generally believe there's more room to run here.
That's a really powerful story of fundamental strength underpinning those numbers. But, even the mightiest ships face storms and can benefit from tailwinds. So this raises an important question. What are the potential headwinds, the risks, and the catalysts that could really shape this attractive future for TSMC? Let's tackle the risks first.
Right, risks. The elephant in the room, of course, is geopolitical, just is. The primary risk, creating this persistent sort of overhang on the stock, is the ongoing tensions between China and Taiwan. It's an external factor, a big one, that simply can't be ignored and requires careful consideration by any investor.
Absolutely.
Beyond that, like any company in its sector, TSMC is inherently exposed to the cyclical nature of the semiconductor industry. Demand ebbs and flows. While their leadership position often insulates them somewhat, industry-wide downturns can still impact demand for their services.
Sure, the whole industry can catch a cold.
Exactly. And finally, there's always the risk of customer concentration. Relying very heavily on a few key customers, while great when times are good, could pose challenges if demand from those specific clients shifts dramatically or they decide to diversify suppliers.
Okay, those are certainly significant, complex risks to keep in mind. But what about the other side? The powerful tailwinds, the catalysts that could drive further growth and really solidify or maybe even enhance this attractive rating.
Yeah, on the catalyst side, the biggest one is pretty clear. Unabated AI demand. TSMC is the sole manufacturer for many, if not most, leading AI chip designers. That makes them absolutely indispensable to the ongoing AI revolution. As AI permeates more industries, gets more sophisticated, so too does the demand for TSMC's most advanced chips. It's a massive driver.
Hard to overstate that one.
It really is. Another key catalyst is their technology roadmap execution. They have to keep delivering. Continued successful execution on advanced nodes, like the highly anticipated 2-millimeter process coming up, is just crucial for maintaining their technological leadership. They have to keep innovating faster than anyone else. It's a constant race.
In the new factories.
Exactly. That's the third big one, their global manufacturing expansion. Building these new fabrication plants in the U.S., in Japan, in Germany, it not only expands capacity to meet all this burgeoning demand, but it also strategically de-risks their geographic concentration. It offers more resilience against potential disruptions tied to Taiwan. These are really powerful forces pushing them forward.
What an insightful exploration into TSMC. Really fascinating. We've seen how a company can appear to have, a high valuation on some current metrics, yet be considered genuinely attractive when you look past today's headlines. When you dig into its future earnings potential and examine the rock-solid fundamentals supporting it all, it's a testament to the power of looking beyond the immediate, isn't it?
Absolutely. I think this deep dive really highlights that a genuinely informed view often requires more than just glancing at today's stock price or the latest headlines. It's about dissecting the forecasted growth, Understanding the strategic positioning and appreciating the nuance across different time horizons, TTM, FWD1, FWD2, that's where the real story and often the real opportunity lies.
Well, thank you for joining us on this exploration of TSMC. For you, the listener, we leave you with this thought. In a market often driven by immediate perception and, let's face it, sometimes hype, how might you weigh the current visible valuation of a company against the less obvious but perhaps more profound long-term strength and projected earnings power, especially for a company that is quite literally building the future of technology? Something to ponder until next time.